Lebanon. The year is 2018. The central bank was running what we now know was one of the world's largest Ponzi schemes. They were paying around 12% interest rates and drawing in massive deposit flows. But they were using those new deposits to pay the high returns to the old depositors. The very definition of a Ponzi scheme. Instead of using the returns generated by what the depositors or the investors' money generates, you can only pay out by going and gathering new funds. As a result of this artificial wealth this created for the nation, Lebanese people felt rich. They spent like crazy. They bought luxuries galore. And in 2019, their central bank collapsed. The nation was plunged into hyperinflation, which reached the worst rate of hyperinflation in the entire world by the year 2022. And the Lebanese pound lost more than 90% of its value from 2019 through 2022. Now, most of this I learned secondhand from my friend who lives in Lebanon. And he told me it was really interesting, especially when the crisis first hit, because people still were carrying around their designer bags, wearing their designer clothes, driving around their Mercedes, while they waited in line for their rations of bread. Because those old luxuries that people bought when they thought they were rich are now the only things people had left. Now, today, people say it's impossible for something like that to happen to the United States government, despite the fact that it operates the exact same way. Economists are adamant that defaults and crashes can't occur when a government issues debt that is denominated in a currency it controls. And they say the fact that the US dollar is the global reserve currency puts it in an even stronger position, a position that it can abuse even longer. But what they're ignoring is the fundamentals, the structure of how the game of money and finance actually works. Because we're still doing the exact same thing that every time it's done throughout history leads to the exact same result. And if you expect the next 10 years to look anything like the last, you'll probably be very surprised. There is a long-term debt cycle at play here, a cycle in which each phase lasts multiple decades. And we have just entered into the next phase of this long-term cycle. Ray Dalio has said many times and in different ways that people tend to think that the near future will look almost identical to the near past. Now, people are not technically wrong about the fact that history tends to repeat itself, but what they are wrong about is the time frame. They haven't zoomed out far enough. For the last 40 years, from 1980 through 2020, we have been in one particular phase of the long-term debt cycle. And especially over the last 20 years or so, we have seen the exact same pattern of events play out over and over to a greater extent. In the late 90s, there was a hedge fund called Long-Term Capital Management, and they engaged in a type of trade called a relative value trade. Essentially, they would buy and short two of the exact same things for a very small difference, maybe 1 cent. These were debt instruments, and so because they were the same thing from the same issuer, it was basically a risk-free trade. All you had to do was wait till maturity, and you get to keep that 1 cent difference. As a result, they were able to obtain massive leverage to use this trade all over the global markets. It became so large and attracted so much attention from copycats that basically this relative value trade started to increase the risk of the global financial system. As always happens when you find a risk-free trade, then load up on leverage in order to squeeze every penny out of it, eventually this got them into trouble. They started having to unwind these trades at massive losses, and it actually put the entire global financial system at risk of collapsing. So the Federal Reserve got Wall Street together and said, Wall Street, you take care of this. Big banks, bail them out, make it happen. And they did. The banks absorbed long-term capital management, shut it down, and slowly unwound the rest of the book. A great read on this whole story is When Genius Failed by Roger Lowenstein. But there's an old proverb that says, do not underestimate the day of small beginnings. And that one little move, Fed orchestrating without even paying for or directly causing something to happen, set the precedence for the next time a bailout needed to happen. And the next time came just a few years later when the dot-com bubble burst. This is where the invention of the Fed put came from. Originally, it was called the Greenspan put, who was the chairman of the Federal Reserve at the time. In order to help soften the blow on the economy from the dot-com bubble starting to burst, Greenspan lowered interest rates. That lowering of interest rates fueled the housing bubble, which triggered the great financial crisis. And we all know that that was dealt with not only by lowering interest rates, but on top of that, they also had to print money to bail out the banks. Fast forward to 2018, when they finally tried to get rid of these assets off their balance sheet, and the market could not handle it. The market started to crash. In December of 2018, Powell decided to reverse course, pivot, because of this taper tantrum. But that wasn't enough, because in September of 2019, less than a year later, the repo market started to blow up, and the Fed had to intervene and bail out the repo market. We all know what happened in 2020 when the next crisis came around, and they had to print trillions of dollars to bail out the entire economy, not just the banks this time, and lower interest rates to zero. So we see this pattern of one small orchestrated bailout leading the precedence for the next bailout, the next lowering of interest rates, the next printing of money, and so on and so forth. Only this last time, the trillions of dollars spent and the lowering of interest rates caused record-smashing inflation. Now today, many people expect that we will face another economic crisis again soon. Many people also expect that following the last 20 years of precedents, the Federal Reserve will pivot and bail out the economy yet again. But most people who expect that are forgetting one very big detail: escalation. In order for the bailout to work last time, it had to be so much larger than all the other bailouts before that it caused rates of inflation that we haven't seen since the 1980s. And that's just if you believe the official numbers. And that inflation is still here. Said another way, we are in a new phase of the long-term debt cycle. So don't expect the bailouts that happen this time to look like they looked during the last part of the cycle. For the next moment, I would like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why I think Monetary Metals is doing something revolutionary goes back to when FDR outlawed gold ownership with Executive Order 6102. What most don't know about this executive order is that it also outlawed the gold clause that was common in debt contracts that allowed people to get repaid in gold if they wanted. Fast forward to 1971, when Nixon took us off the gold standard for good, and there was no reason for that law to be in place anymore. And what even fewer people are aware of is that law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legalized in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they are doing and nobody else is. They have created a way for you to start getting on your own personal gold standard by paying you a yield on your gold, denominated in gold, priced in gold, and paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you have 100 ounces of gold at 4%, you would end the year with 104 ounces of gold. It is denominated and paid in gold. Regardless of the price of gold, regardless of what the dollar does, your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do, getting to know the team. And as a result, I've become not only a customer myself, but I've actually also personally invested into the company. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and get started by opening an account today. There's another problem as well. In order to deal with this high inflation, the Federal Reserve is raising interest rates to try and smash economic activity. Interest rates across the curve are around 5%, with government borrowing rates for 6 months at 5.5%, which is the highest they've been since 2000, all the way to the 30-year at 5%, which is the highest it's been since 2007. But these high rates themselves are causing a fiscal spiral that will actually keep inflation around. Take a look at what happened from 1940 through 1980. This phase of the long-term debt cycle that lasted 40 years saw rising interest rates. Even though there were times where rates dropped, the overall trend was higher and higher. Over the exact same time frame, we also saw the rate of inflation going higher and higher. Even though there were short-term periods where the rate of inflation dropped, the overall trend was higher and higher. So we had 40 years of rising rates and rising inflation. Now let's take a look at the next 40-year part of the cycle from 1980 through 2020. 1980, when rates peaked, we saw a 40-year trend of interest rates moving lower and lower and lower. Yes, there were times when rates moved higher, but the overall trend was down and they bottomed at basically 0% in 2020. Over the exact same time frame, we saw the rate of inflation moving down. And while there were time periods where inflation spiked, overall the trend was lower, again bottoming in 2020 around 0%. 40 years of rising rates and rising inflation, followed by 40 years of falling rates and falling inflation. But here's the deal. When you get to zero, you can't go past it. And right on cue, look at what's happened over the last 3 years since the cycle turned. The rate of inflation has moved higher, just as interest rates have as well. We are back in a rising interest rate and rising inflation environment. Remember, this is a long-term debt cycle. So while there will be periods where these will be moving down, like the inflation rate has been moving down for the last year, the overall trend is higher and higher. This also means that what worked for the last 40 years will likely be different than what works in the next 40 years. Things like passive index fund investing that gained popularity when? In the last 40 years. You didn't hear anybody talking about passive index fund investing prior to the last couple of decades. Things like long-term bond investing. When interest rates are falling for 40 years, you are in a long-term bond bull market. But when interest rates are rising, things have flipped. The cornerstone of modern portfolio theory, the 60-40 portfolio, is likely dead. Things like growth investing will be replaced by income and value investing yet again. Even if you expect just a reversion to the mean, you would expect income investing to far outperform growth investing just to get back to the long-term norm. And worse, this change is likely to lose a lot of people a lot of wealth. There is no substitute over the long-term time horizon for being an active investor. Passive investing is simply gambling that somebody else will make the right decision with your money. There's no substitute for intentionally choosing every asset you own, being mindful of your investments, intelligently hedging so that you are never exposed to large losses. There's only 4 outcomes that can ever happen with investing, and that is you lose a lot or you lose a little, you make a little or you make a lot. If the only thing you do is eliminate your large losses, then your small losses and your small wins will cancel themselves out, and your big wins will drive your performance. And if you don't know how to do this, you're in luck. This is exactly what I help people learn how to do who are members of Heresy Financial University. And by the way, I'm running a Halloween special. If you use code SPOOKY, SPOOKY, you get your first month for just $1, and this code stops working at midnight on Halloween, so don't wait. Take a look at this chart of the inflation that happened during the 60s and the 70s. It's important to note that it happened in waves. It was not a straight line up. There were times where the rate of inflation fell, even though the overall trend was higher for longer. This means that any victory laps that people are running today, with the rate of inflation officially dropping from 9% down to about 4%, are likely premature, because massive deficits today are what will continue to fuel inflation into the future. Deficits that cannot be stopped anytime soon. The federal government is borrowing more to cover its expenses than it has in any year outside of 2020 and 2021. And a massive portion of that borrowing is simply to pay the interest on the debt, because they're now having to borrow at rates that are much higher than they've had to borrow in decades. Simply put, just paying for the debt itself is getting more expensive, causing them to use more debt. This is why it's called a spiral. And as they borrow more, they have to pay higher rates in order to attract more lending. These deficits fuel massive misallocation of resources and increases in prices on the very things they're spending that money on. And look at what it's doing to the economy. It's lulling the US economy into a false sense of security, with things like the US GDP numbers growing at a 4.9 annualized pace in the third quarter. These GDP numbers shocked analysts, shocked the market, coming in way higher than expectations. People were flabbergasted, thinking, how in the world could the economy be so strong and growing so well? Newsflash, it's not. Just like the people in Lebanon in 2018. Thought everything was great and thought they were rich. Consumer spending was responsible for 2.7 percentage points of the total GDP increase, despite US households having more debt than they have in history, and despite the personal savings rate being as low as it was during the Great Financial Crisis. People are still acting like they have money, and they're spending it like crazy. These people are in for a rude awakening. Inflation is going to take off again. The deficits will continue to expand, fueling this. Rates will be pushed much higher as a result. And one day, people will wake up and realize that the GDP numbers, wages, and their personal wealth are going up in dollar terms only. And the coming decades will not look like the past, not the past ones that we have just left behind. We have a deleveraging to experience, and it most likely won't be enjoyable. Rates will continue to move higher and higher to multi-decade highs in the Fed's attempt to crush borrowing and investment. And inflation will not be stopped for much longer than people expect. A third wave is coming, and it will probably be more significant than the last, just like it was during the 70s. And when history records that it was in fact the US government running the largest Ponzi scheme in history, not Lebanon, it will be those who saw it coming and who were prepared that will be the winners on the other side. As always, thanks so much for watching. Have a great day.